Mike Newmeyer again, financial advisor, and I want to give you my phone number, 410-902-0464. Call me with any questions. We take questions and then we try to answer them in our podcast. And in fact, today's podcast is about a whole lot of things that people have been asking me. Specific questions, but the overall topic of cash management. And nobody uses that word, but I'm giving you a kind of a summary concept that really all these things add up to, cash management. And a lot of folks are concerned now about credit cards and bad debts and all kinds of things like that because of what we've been through with COVID and what we've gone through in the economy. And people ask questions like, how do I not lose money in the market? You know, no magic. There's some answers there, but no magic. But I want to talk about some very specific things. I made a lot of notes here. And so I'm going to start out with understand how you got into debt. If you're in debt, how'd you get there? And the typical thing is that people don't really plan. And I'm going to cover some specifics along that line. And then taking steps to correct the problem, obviously, and we're going to talk about some of those. And then general strategies to eliminate debt. You know, closing non-essential accounts. The average person I talk to has 2 or 3 credit card accounts that they don't use, or they think they don't use, and they've got some debt accumulated on it. And with today's rates, they could be paying 25% a year annualized. You know, that's what, and does not help. It does not help your credit rating. In fact, the more accounts that you open, the worse your credit rating can be, even if you do a good job with it. And then, of course, if you miss a payment because you overlooked it, then that's another story. So, you know, consolidating, that is to say, getting rid of as many non-essential cards and so forth, very important. And any other accounts that are non-essential that you could consolidate. But when you consolidate credit cards, not only look for the lowest possible annual rate, which of course divided by 12 is your monthly rate. Don't just look for that. Look for cash back programs. That is to say, where you get money back based on your purchases. There's some out there that will give you 4% on gasoline. There's some out there that will give you 2% on everything. So look for those, because that accumulates. The more you buy, the better off you're going to be. Not that you should buy more, but the point is, why not get some of that cash back? And then, of course, increase your payments on any, you know, bad debts or high interest debt. If you can consolidate it, as I said, that's a good thing. But in any case, try to pay down and eliminate the high interest accounts. You should sort of audit all your accounts on a monthly basis and look what's happening. Because remember, the rates on credit cards, as an example, you know, are variable. They don't have to stay the same all the time. They can change those. And guess what? They're not reducing them right now because interest rates are up. Unfortunately, interest rates are up, so it's not a great time to do a lot of things that we would normally suggest as a part of cash management. And I'll point some of those out as we go along. And then once you've eliminated your highest interest rate accounts, go to the next one, where you can't, if you can't consolidate. Consolidation is, of course, the real answer to the lowest possible rate, and then, of course, make it a cash back, you know, card, if that's what we're talking about. If we're talking about cards, seek credit counseling if needed. I give a lot of credit counseling to folks that come in, say they're having a tough time managing their money. Because if we're going to help them get ready for retirement, obviously we need to help people, you know, manage their money. And in retirement, you're going to have more fixed income. So you really need to know how you're going to manage the money you've got coming in. Some people do a very good job. There's an old axiom, be your own bank. So if you really, really are serious about that, then obviously, and if you have the talent and the experience, you can do a good job managing your own money, and that's great. Once out of debt, pay the balance every month to close the account. So that's the secret, is obviously don't let credit card debt accumulate. Now that's discipline. But if you look at them every month, and if you look at the balances every month that you're carrying over, that could help you come to a point of control. Husbands and wives have to work together on this, obviously. If one person, is a spendthrift and the other one is a saver, well, that's kind of opposite ends. But the point is, you got to come together on these things, and you have to talk about these things, in a compromising manner, but work towards reducing debt, period. Okay. And then there's things that we would suggest with better interest rates out there if they were, and that would be a home equity line to eliminate all your bad debt at once, because normally the rates on home equity lines are lower. Now that's not totally true anymore with what's going on with interest, but just keep that in mind, that there might be an opportunity there in order to consolidate and eliminate all the bad debt and get your interest costs down and so forth. But that may not be available today because interest rates are all high. But you can ask the question. You can ask your bank that question. What do they say? And then convert non-deductible interest to a deductible interest if you can. So if you can't deduct the interest, then you want to get it into accounts where you can deduct the interest. Now that's where the tax man comes in, or the tax woman. Getting tax advice on some of these things is very important. Here's some additional ideas. Money market accounts. Today, 1-year CDs, you can get 5% if you go to the right banks. Not all of them. We're not used to getting any interest on our savings accounts and checking accounts anymore, but you go to the right banks, you can get up to 5% on a 1-year CD, and you can get almost that much, 4.5 or something like that, on a money market account. Now, money market accounts have some restrictions, such as maybe you can only write 5 checks a month. But if you can live with those kinds of restrictions, then you should use a money market account. That will help you, offset the interest you're paying on credit cards. If you can use a money market account and get some interest every month on the balances. Okay. And think about this. If you're going to put money away for retirement, if you put money with a fixed index annuity, which is what we deal with, you can get a bonus. Let's say you got $100,000 in a retirement IRAs, and you transfer that money into a fixed index annuity, and you pick up a 25% bonus. That's certainly going to offset some of the negative experience you're having, in the market. As an example, if the market's not been good to you, and you take, or maybe you're to the high point in the market and it's going to go down, you transfer the money at that point, and you get the bonus. That could really help you building your retirement money, especially if there's a roll-up. What's a roll-up? Let's say you've got an account, you put 100 in, you get 25, it's 125. Well, what if you gain 7% guaranteed a year? If you can get a guarantee of, say, 7% a year, that's going to be tremendously beneficial to you when it comes time to retirement. So that's just one idea. Budgeting, something nobody wants to do. Next to paying taxes, I'd say budgeting is probably number 2 when it comes to things that people don't want to do. But it's really important. It's really important. And once you get into the habit of doing it, it gets easy. But you want to budget on a monthly basis. It's not something you want to put off. You've got to get into into repeating it on a monthly basis. Sitting down and looking at your cash flow. You can use a spreadsheet. Maybe you want to do it on a computer, with an Excel, whatever you can do. In writing, computer, it doesn't make any difference if you keep track of the numbers. So you list the items that you're spending money on, and then you list the months. And you look at what you're spending each month, and you plug in as the months go by. And look at the total that you're spending at the bottom. And then look at your income and compare the two. So retirement and living with cash flow means, income and expenses. Income and expenses. Those are the 2 elements. You can't get away from income and expenses. You'd like to have more income, and you'd like to have less expenses. But the only way you're going to get control is to look at them. It's not that hard. You can look at your checkbook and take those items. You can look at a credit card statement and see where you're spending your money. and so forth and so on. But income and expenses, budgeting monthly. Budgeting monthly. Married couples, one person might be the one that wants to do it, but you got to review it. Both of you each look at the results each month. Adjust accordingly. Why are we spending this money? Why are we spending that money? Do we need to spend this money? Do we need to spend that money? And so forth. And then look at recurring expenses that are ACH, that is to say, that are coming out of your accounts automatically. You can lose control of those things really fast. You might see, gosh, why are we spending this? It's going out every month. We don't need that anymore. You want to get control of those things. Another thing you want to do is pay yourself first. What does that mean? That means put aside 10% of the income every month. You say, well, I can't do it. Well, budget first and then try to do 10%. So you're building up that rainy day fund. Okay, you're building up that rainy day fund. And if you build it if you do it properly, a lot of it will never be used for emergencies. And then you can take what's extra and put it into retirement accounts. So those are some possibilities there. And then a plan for your end of year taxes. What taxes are you going to have to pay at the end of the year? Or what property taxes are you going to have to pay? Whenever you pay them. And then, you can set aside money for that each month. If you set aside 2% for property tax or whatever percentage, it's not going to hit you when it comes. You're ready for it. You're ready for it. These are the disciplines that are really necessary to manage cash flow. Property taxes are a perfect example. You set aside for those things, then they don't just hit you. Control your utility costs. What does that mean? Well, obviously, turn the lights off, but besides that, track them. It's awful easy in the summertime to leave the air conditioning running all the time. And there are some utility people that will tell you that's the best thing to do. I'm not convinced of that. I think you got to experiment a little bit. Find out if you're better off turning them off and turning them on. Find out how you can save money. Maybe you're air conditioning more than you need to be. You need to get that under control. The same thing with heating in the wintertime, of course. Nobody wants to be in a cold house, but you don't want to have what happens in the winter and the summer oftentimes is your utility bills double. Unless you can afford that, I would say try to control it more. And that means also auditing your utilities. Are your heaters and cooling systems, are they operating up to optimum? Do they need to be checked? A lot of the companies that you deal with will actually give you an inspection once a year at no cost. Sign up for those things. See where you can reduce your utility costs. Very, very important. And review all your life insurance, or review all your insurances. Look at your insurance on your home. Look at any liability insurance you have. Look at all your automobile insurance. You may find that going on a miles driven auto policy is better for you. But look at those things. Audit them once a year at least to see where you can reduce your expenses in insurance. Now, these are just a few ideas. And we'll come back with more on different topics, on different days, on different podcasts. And I hope these things help you. And if there's questions you want answered, please call us. 410-902-0464. 410-902-0464. Thank you very much.